Have you ever wondered what working capital is and why it's crucial to businesses? Well, it's all about the short-term financial health of a company. It's the difference between a company's current assets, such as cash, inventory, and accounts receivable, and its current liabilities, for example, accounts payable. This balance of assets and liabilities is what keeps the day-to-day operations of a business humming along smoothly. Think of it as the lifeblood that fuels a company's engine, ensuring it has enough resources to meet its short-term obligations. It's the money used to pay for everything from the electricity bill to the salaries of employees. It's the stock on the shelves and the money owed by customers. It's the funds needed to keep the business running on a daily basis. Now, why does working capital matter so much? It's because effective working capital management is a cornerstone of a company's financial stability and operational success. It's about striking the perfect balance between the amount of cash on hand and the inventory, accounts receivable, and accounts payable that a company holds. When a company manages its working capital effectively, it can improve its cash flow, reduce operating costs, and maximize profitability. But this is not a walk in the park. It requires careful planning and monitoring of key financial metrics. Consider a company with an excess of inventory. That might seem like a good thing, right? More products to sell. But in reality, it ties up valuable resources and can lead to reduced cash flow. Conversely, too little inventory can mean missed sales opportunities. And what about accounts receivable? If a company has a large balance of money owed by customers, it can face challenges in collecting payments, impacting its cash flow negatively. Similarly, a high accounts payable balance can lead to difficulties in paying bills on time, potentially damaging relationships with suppliers. Let's paint a picture. Imagine running a small retail store with $50,000 in cash, $100,000 in inventory, $20,000 in accounts receivable, and $10,000 in accounts payable. To manage your working capital effectively, you'd need to balance your cash flow with your inventory, accounts receivable, and accounts payable. You might reduce your inventory by $20,000 to free up cash for new marketing campaigns. You could also follow up with customers who owe you money to improve your accounts receivable balance. And perhaps you could negotiate better payment terms with your suppliers to improve your accounts payable situation. So, to wrap it all up, working capital management is the unsung hero of business operations. By efficiently managing their working capital, companies can enhance their cash flow, cut down operating costs, and boost profitability. It's all about balancing cash flow with inventory, accounts receivable, and accounts payable to ensure a smooth run and enough resources for short-term obligations. It's not just about surviving, but thriving in the world of business.